Well, 2023, it was an eventful time for ag law and tax developments here in the States. And as we embark on a new year, it is important to look back on the lessons that were learned from these various issues. And the man who joined us all through last year and now here to break it down, Roger McEowen with the Washburn School of Law. We're going to continue to tackle this list of these top 10 developments, try to get to as many as we can. So, Roger, from what I understand, number 8, new corporate reporting requirements. What do we need to know here?
Yeah, good to be with you, Suzanne. This is a big deal. This is a new law that took effect January 1, and it's going to require many farming and ranching operations to file a report with a Bureau of the Treasury detailing those people and listing those people that own or control at least 25% of the company. Now, sole proprietorships don't have to register but those businesses that sole proprietorships don't have to file, I should say, but those businesses that register with the state have to file this beneficial ownership information report. Now, there are exclusions. And another exclusion besides sole proprietorships would be for businesses that have 20 or more full-time employees or reported at least $5 million on their most recent tax return. So that's going to exclude some of the largest farming operations out there. But many are going to have to file this report by the end of this year if they were in existence prior to 2024. One key point on this, Suzanne, is that if the farming or ranching operation is large enough to be excluded, in other words, you're over that $5 million threshold, if you have related entities, such as an equipment LLC or a land LLC, those related entities are not exempt. Your big operation is not going to cover those. So you have to file a report telling the government who owns those related entities.
Well, big important information there on those related entities. Thank you for that. Number 7 we're going to on the list involves a $1 billion biofuel tax fraud conspiracy. Let's recap this.
This is a mess. In fact, IRS Criminal Investigation Division listed this as number 1 on their list of cases for 2023, and they call it the biggest tax fraud scam in U.S. history. And so at the foundation of this criminal activity was the renewable fuel standard that was created in 2005 and expanded in 2007. Under that, as I'm sure many of our viewers and listeners know, the government offers pretty lucrative subsidies and tax credits to companies that convert crops such as soybeans and corn, as well as other products, into renewable fuels, the most common of which is corn-based ethanol. Well, included in the RFS are biofuel production incentives known as RINs, or Renewable Identification Numbers. One of the problems with that is the way that it's set up, it allows the possibility that a RIN price could be negotiated by a biofuel company with an oil refiner, with the company using a fake 38-digit number that the government requires. The government requires a 38-digit number, and they can use a fake one. They figured out how to do this to game the system. So the RIN buyer would then claim to have shipped biofuel to be refined, but the other party, the buyer, is in on this too. And so no fuel is actually bought or sold, and they're just grabbing the tax credits. And so both of them are in on the scam. And that's what happened in this case. You get 5 people that were sentenced to lengthy prison sentences for a taxpayer scam of over $1 billion.
Pretty sneaky. I'm moving on to number 6. It focuses on self-employment tax and limited partners. Highlights here?
Yeah, this is a big deal that goes back a quarter of a century. In 1997, the Treasury issued proposed regulations to tell us whether distributions that a limited partner and limited partnership received would be subject to self-employment tax. Congress froze those regulations in 1998, saying, well, we'll tell you what we want the tax treatment to be, but Congress has never done anything. And so the IRS has just had to proceed with their proposed regulations. And we had a significant tax court case in 2023 involving an investment company on the East Coast that didn't pay, the limited partners did not pay self-employment tax on their distributions. And they said, well, we have a state law defined limited partner interest, therefore we're exempt. And the tax court, relying on those proposed regulations, said, no, you're not. If you are participating at all in management, your distributions are subject to self-employment tax. as well as if you are a professional services firm, such as an investment firm or a hedge fund, you can't use that limited partner exemption anyway. But we can still do this for our farms and ranches. And there's even a bigger case coming behind this one in 2024, Suzanne. So this is going to be a big issue in 2024.
Sounds like we're going to be talking about this again. But boy, you talk about lessons learned. Sometimes not so many of those lessons learned. Thank you, Roger, as always. Roger McEowen with the Washburn School of Law. Love having him break it down for us. Of course, we're going to connect with you next week as we continue the top 10 developments of tax law from 2023.